I'm Stacy from Fun Caliber, and I'm here to answer the million-dollar question, value or growth? Choosing an investment is a bit like shopping for the right pair of jeans. You want it to be a perfect fit for you and go with the rest of your stuff. Some people like to buy cheaper pairs that may not last as long, but are on trend. Others might prefer designer jeans that will last a decade. Neither is the correct option, it just depends on your personal preference. In the investment world, this analogy translates into value versus growth. Value investing is all about finding a bargain or investing in unloved companies whose share prices have fallen. Value investors like finding companies that are trading cheaply, i.e., their shares are currently worth less than they think they should be. Think of it like finding a good Black Friday deal or a pair of designer jeans in the local charity shop. As the team at SCHRODER told me, much about value investing is about exploiting human emotion. Investors typically get overly cynical in bad times and overly greedy in the good times. A value investor looks to exploit this. And, like any shopper, value investors can suffer from buyer's remorse. To avoid this, fund managers need to build a strong understanding of why something looks cheap. Is it out of favor for a good reason, or have other investors missed something positive? It's a skill set best left to the professionals. Growth investing is the flip side. Sometimes called quality investing, it's when you invest in good quality, established companies or those that are growing more than their competitors. And to get these characteristics, you're willing to pay up. When you're shopping, these are your quality purchases where you believe it's worth paying more. It's important to remember that growth managers are looking not only for winners, but those with the potential to grow. This means considering the sector the company is in, as well as the company itself. Simply put, a growth stock should be growing. Now time for the million-dollar question. Which strategy is best? While one isn't better than the other, they do tend to go through periods where one delivers superior returns over the other. This usually depends on how the economy is performing and whether interest rates are heading up or down. Low interest rates tend to favor growth stocks, and this is why growth has been outperforming value for the last decade. Also, technology has been booming, which is a growth area. Value strategies tend to do better when economies are doing well. For example, when the world reopened again in 2021. Over the very long term, this strategy has also outperformed. It makes sense. It's easier to make money if you've bought something cheaply and then sold it on for more than you bought it for. But it doesn't mean that growth investors can't profit. Of course they can, and they have. But fundamentally, growth companies often need more capital to continue to expand, and that can sometimes prove difficult. Ultimately, a mix of both styles is probably the best way to build your portfolio for the long run. That way you can make the most out of every economic environment. So, here are 3 value funds to consider. Fidelity Special Values Investment Trust invests primarily in unloved UK companies and waits for them to come back into favor. Manager Alex Wright has said that he is drawn to unfashionable stocks that are out of favor and trade on cheap valuations. He's looking for potential positive change that others haven't yet seen. TM RWC Global Equity Income is run by a team of 4 who buy the controversy and sell the consensus. This means that the fund has a genuinely contrarian approach, and the portfolio will have a distinctly different look to many other global funds. The strategy has historically outperformed in volatile markets. SCHRODER Recovery is a deep value fund. It has been run by the same lead manager since 2006, with a continuity of process and a very consistent track record. Investors in the fund need a long-term investment horizon, which is increasingly hard to do in today's world, although the track record of this fund suggests that it's not impossible. Now, 3 growth funds that you might want to consider. First is Scottish Mortgage Investment Trust. The trust typically holds between 50 and 100 companies worldwide, united by their strong growth prospects. The managers focus on finding tomorrow's winners and aim to identify businesses which have the potential to disrupt their industries. They focus on the long-term potential of a business rather than its current value. In their own words, they own companies rather than rent shares. T. Rowe Price Asian Opportunities Equity invests across Asia ex-Japan in a concentrated portfolio of high-quality companies. These companies tend to be established with leading market positions and good management teams. The fund manager Eric Moffat has a tortoise versus hare style of investing, which works wonders in the volatile markets of Asia. And lastly, AXA Framington American Growth. This fund looks to uncover the biggest growth stocks in the U.S. market, targeting innovation, unique brands, and intellectual property, just to name a few. Manager Steve Kelly has managed the fund for over 20 years. With a bias to mid-cap stocks, the fund is able to benefit from the exciting, less researched companies in the U.S. market. Want to learn more about value versus growth, or perhaps start researching your next investment? Visit fundcaliber.com, and don't forget to like and subscribe for more weekly videos.